Hello everyone, welcome to my YouTube channel. This is Arjun Jayaraman and I welcome you to my multi-bagger stock series 3. Today's session is for small capital traders and investors. Before we get started, a quick disclaimer. This is not a advice to buy or sell shares or trade in currency futures. Investment in securities market is subject to market risk. You must consult your advisor for any trade advice or before taking any positions stock market. I am not a SEBI registered advisor and these contents are purely for educational purposes. So today's session is going to be in the currency segment. So we will talk about USDINR. So in my previous video, we had seen how we can quickly identify very major trends using certain simple but highly effective patterns like the shooting star, dragonfly doji, volumes, and other several cyclical patterns. In my second series, I had shared 4 such examples. So today we will see how the currency segment looks like and what it means to trade in the USD INR pair. Generally, we have seen the Nifty index going up, and during the same cycle, we have also seen the USD INR pair trading lower. So, what this means is, higher exports, more USD coming into the country, a lot of selling happening, and the rupee getting stronger. When the stock markets are doing good, generally the FII cash flows are also really good. So again, the USD is sold to be exchanged for the Indian currency. So generally the rupee becomes stronger and the dollar becomes weaker during such periods. And similarly, vice versa, when the market falls or the Nifty falls, generally we have seen the rupee weaken and the USD is more in demand as people generally look at exiting the Indian markets. So when we see the currency pairs, what does it mean? USD INR, when we hear it is trading at 73, what it actually means is to purchase, in order to purchase $1 we will need 73 Indian rupees to buy the quoted currency pair. So typically the first currency, which is USD, is the quoted currency. So it is quoted in the currency that is following the quoted currency, which is the INR, which is the Indian rupee. So USD INR 73 means 1 USD is equal to 73 Indian rupees. Currency pairs are usually traded up to 4 decimals. So the last 2 decimals are traded in multiples of 0.0025, 0.0050, so on and so forth. Each contract is traded in 1000 US dollars. The currency market in India trades from 9 a.m. in Indian Standard Time to 5 p.m. Indian Standard Time in the National Stock Exchange. However, globally, in various other markets, all currency pairs are traded 24 hours for 5 days, Monday through Friday, in their respective exchanges. So, the subsequent day, when we see the Indian market opening, usually we see a gap up or gap down depending on how the um, currencies have traded in the global exchanges. So if you have left a open position at, let us say, 73, chances are highly likely that it can open a gap up of 25 paisa or a gap down of 25 paisa. Sometimes we have seen a rally of up to 1 rupee in a single day, and we have also seen rallies up to 3-4 rupees within one calendar month. The contract margin is really less. It's hardly 2.5 to 3% of the contract size. So exchange charges typically 1,800 to 2,300 rupees depending on the various margin requirements. However, if you're looking at buying or selling deep in the money options, then the margins may differ accordingly. Now, because of this very low margin, even a slight swing of 1 rupee can actually mean 1000 rupees of a margin requirement. So, that would mean on a 2000 rupees margin, 1000 rupees is nearly 50% mark to market. So, typically, people misjudge this and they take very high positions, and continuous gap up, gap downs can really crush the portfolio. So it's highly recommended to do strong money management and also keep the positions hedged if you are planning to trade in currency pairs. Now, here's a typical example. Today we will cover one more pattern like I cover in most of my previous videos. Today we will talk about the ascending triangle pattern. This is taken from Investopedia. Now, when we correlate it with the currency, we can see that it's kind of a triangular pattern. And as we can see, the breakout points from the highs, we see a 2013 high at 69, and Feb 16 again we see it closer to 68.88, again an exact 68.8 in November 16, and we can see a successive conclusive close above that particular price. Now while we see uh, dragonfly doji here, we can also see that that high is getting broken in the subsequent month, where all these shorts will get taken, and then this currency pair is likely to shoot up significantly. So going by the height of this um, triangle, we can see that there is likely to be a target of about 4 rupees. So this swing from this high to low is typically 4 rupees. So usually we expect a breakout target from here of around 3.5 to 4 rupees, which places it somewhere around 73. And there is a little wave calculation as well. Going by the wave theory, the extended wave runs up to 75. So this was a typical movement that we could see by virtue of this breakout point, and let's see what happened later after this analysis. Now this is a 15-year monthly chart. We can see that rally or the breakout that we saw from these levels very clearly. This is the dragonfly doji that broke out, and then we saw this rising for the next 3 monthly calendars. Significant rally, 3 months of highs. So all these shorts during this period got taken out, and then it became a bull rally all the way till 75 in line with the projected target. So anybody who was trading for 3 months in this cycle would have made a very significant return, since there is a very high leverage. So some of the very important averages that we need to see here are the 5, 8, 13 and 21 month. So typically a 5-8 crossover will give the good directional view. 13 will give us a very good support. If that breaks, then the next support is expected at the 21-month moving average. So here we can see that during a good trend, you see the currency taking support at the 5-month moving average. Then it is followed by the 8-month moving average. And when we see the crossover of a 5-8, usually we see the trend going down. Again, when it cracks below the 13-month, there is a confirmed sell-off, and it usually rallies and finds support around the 21-month moving average. Now 21 moving average is usually starting from here, and we see this at these levels. Now we have also drawn two channels here. Now a channel breakout or breakdown also happens. Now we can see that there has been a breakdown during this period, and once it started rallying above this, it's fairly stayed for the last 8 years within this channel range, except that it broke once during this very strong rally, and then again it dipped within the channel. After that, the currency pair has found it very difficult to break above this particular channel. Again we see it very finding it too difficult to break below the channel as well. Now the 21-month moving average has given support here, and while it didn't give support at this time, it definitely acted as a significant resistance when it broke above this particular pattern, and after that it has never broken it for the last 9 years. So one can expect the currency to find support either at the um, 13 month moving average or at the 21-month moving average. So let's see what happens in the subsequent 2 to 3 years. We also see a little divergence in the RSI. There is a negative divergence. So we see the currency pair going up, but the RSI isn't supporting it. So then we could expect the RSI to fall as low as the 40 mark or 45 levels. During that period, we can expect the currency to fall until the 70 levels. Here is another view of the quarterly charts. So the previous one was a monthly chart. Here each candle is a 3-month chart, so it's a quarter. So we can see that there has been a 5-quarter uptrend followed by another 5-quarter downtrend, so on and so forth. So last couple of quarters ago, all the analysts were very bullish. They were expecting the dollar to go up to 83, but unfortunately, we could see this doji pattern, which is a very significant pattern. As we have seen that the currency reacts really well to the dojis here, and only once it has failed in the last 14 years. That was during this 2013 rally. That was the only time the doji did not work well, but otherwise we have always seen whenever there's a doji at the high, the currency pair has always reversed from there. So we can also expect it to reverse similarly here. Now this number is placed at around 75 level. So also we see that whenever there is a reversal happen, usually we see up to 3 quarters of downtrend. Again, we see 3 quarters of downtrend, or at least we see 3 quarters of sideways followed by another 3, 4, 5 quarters of downtrend. So we can logically expect at least another 2, 3 quarters of downtrend here. So if that be the case, then one can kind of short 75, 74, 73 call options for the next 3 to 6 months and keep rolling down, or you can also short the futures with a stop loss of 76. Now we also have a lot of other strategies which are more risk-free strategies. You can use them at your discretion. Of course, you need to do your own homework. I will cover some of these strategies in my subsequent videos. Quickly, we assume that since the dollar is trading at 74, we are looking at a 1 rupee stop loss, and keeping a stop at 75, we see a 2 rupees downside target, which is a 1:2, and also we see a 1:3.5 in the next 6 months, which is a fantastic return. So one can short naked call. So basically, you can calculate what is the at the money put call premium, and it's usually around 50 paisa. So 50 paisa for put and 50 paisa for call, which is 1 rupee. So typically we go 1 rupee away from whatever price it is traded. So if it's trading at 73, 75, then we would go to 74, 75 and short that naked call, or we can short 75 call as well. And if you get liquid options, you can go and short the October, November, December calls as well, because the probability of the option being in the money over the next 3 months is very, very low. So this is one of the good options to sell. We can also try to do a bear call credit spread. So basically we sell at the money call and then buy an out of money call. That net resultant would be a credit, and as the price diminishes, you will get more of this premium. You can also do a put back spread. Typically you sell in the money or at the money put, and then you buy 2 out of money put options. So you will virtually be putting very little capital or almost no capital other than the margin money, and one option will cancel the other option, and you will still have one free out of money put option, which you can have an unlimited profit on the downside if the currency continues to fall down further. The other strategy you can look at is a bear put debit spread. So typically you can buy one in the money or at the money put, and you can sell one out of money put, which will also reduce your cost of buying this put option. But this will be definitely cheaper than shorting the futures, because you will have less margin requirements for this particular strategy. Number 4, you can also look at a long put ladder, which is typically you buy in the money put, sell one at the money put, and sell one out of money put. Similarly, you can also do a short put ladder, which is again buying one at the money put instead of the previous one where you buy in the money put. Here you just buy an at the money put, and then you would sell a one out of money put and sell one far out of money put. Another strategy which is quite rewarding is you just short the futures and you keep rolling over for 6 months. So when you short the futures, usually the next month futures trades 20 paisa higher. So every month on month, when you keep rolling over shorts, you get 20 paisa here for rolling over shorts. And at the same time, you can also limit your risk by selling an at the money put or an out of money put, and then accordingly your reward ratios will increase quite significantly. At the same time, if your stop loss has to be triggered, the premium that you collect from the at the money put or the out of money put will help you to reduce the stop loss value. We can also sell short straddles and broken wing short butterfly spreads. I will cover all of these in my subsequent videos. Of course, you are expected to do your own back testing before you get into any of these strategies. I wish you all the best. Thank you very much for watching this video. If you like this video, please subscribe to this channel for more such videos. And most importantly, please share your valuable comments and feedback. Thank you very much. Happy trading.